Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst stock. Today we're looking at Rigetti Computing.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
We really have to start with the current financial reality here because it just seems to stand in such stark contrast to all the hype.
It really does. I mean, if you just look at the recent ledger, specifically the third quarter of 2025 results, they were, well, disappointing.
Disappointing how?
Revenue came in at $1.947 million. That missed the consensus estimate, and it's actually a drop from the $2.378 million they reported in the same quarter last year.
A drop year over year.
A drop. And on top of that, their operating loss is still substantial. We're talking around $20.5 million. So yeah, this company is burning cash while reporting shrinking top-line numbers.
Okay, let's unpack this. Because on the surface, those numbers spell trouble. I mean, a revenue miss plus a huge cash burn.
Yeah.
That's usually a recipe for a collapsing stock price. So what is the core thesis that's keeping the market so interested despite these figures?
It is entirely about the projected inflection point.
The inflection point.
Yes. The market is, completely ignoring the current balance sheet pain because they are pricing in a dramatic acceleration starting next year.
And we're not talking about just small linear growth.
No, not at all. Analysts are forecasting a huge spike in 2026. They're projecting total revenue of $21.9 million.
Wait, $21.9 million? That would be, what, year-over-year growth of something like 164%?
Roughly, yes.
How do they even justify a leap that explosive? Where's the evidence that this isn't just, pure fantasy?
Well, the belief is really rooted in their technological roadmap and scalability.
Mm-hmm.
Right now, Rigetti is focused on developing its platform and securing key clients, which is incredibly expensive.
Right, the R&D phase.
Exactly. But the assumption is that their quantum computing platform will hit this sort of scale and efficiency sweet spot in 2026. And that's when the unprofitability, which is, FY 2025 EPS near negative 19 cents a share, will start to narrow significantly.
So it's an R&D spend now for massive leverage later on.
That's the story.
That growth projection is certainly massive, but funding that jump from R&D to full commercialization requires serious capital. We just said the operating loss was $20.5 million. How are they funding this push without just collapsing?
Liquidity management has been absolutely key. They completed a pretty significant $350 million equity raise.
Okay.
And multiple secondary offerings throughout 2025. This has stabilized their balance sheet dramatically. As of the last disclosure, they have very little long-term debt and significant reserves.
What kind of reserves are we talking about?
$26.1 million in straight cash, but more importantly, massive holdings in U.S. Treasuries, about $420 million short-term and another $112 million long-term.
That treasury structure shows some pretty conservative cash management, which is, a reassuring sign in such a volatile sector. But you mentioned something about complexity on the balance sheet. What's the hidden risk here?
So what's fascinating is this residue of their original structure, which likely comes from their SPAC merger.
Okay.
While the debt is low, the derivative warrant liabilities remain sizable. We're talking $240.7 million.
Okay, for the average listener, that sounds like a lot of complex financial jargon. Why does that $240 million liability actually matter?
It's crucial because these liabilities reflect warrants that were granted to earlier investors. It's basically a non-cash liability that has to be marked to market every single quarter.
So if the stock price goes crazy?
It swings wildly. Exactly. If the stock performs well, these warrants increase in value, creating a large non-cash liability on the books.
But why is that bad? If the stock goes up, isn't that good for everyone?
It is, but it means that even though it's non-cash, it reflects potential future dilution. If those warrants get exercised, new shares flood the market. It's a constant source of risk that complicates the whole story.
Let's pivot now from the financials to the tech itself. I mean, quantum computing is a space dominated by giants, IBM, Google, Microsoft. What gives a company like Rigetti a competitive advantage, a moat in this kind of landscape?
Their edge really lies in being an early mover and their operational model, which is all about vertical integration.
Vertical integration.
Yeah, in superconducting quantum hardware and these hybrid quantum cloud solutions, it just means they control the entire stack from the physical chip all the way up to the software interface.
So if they control everything from the hardware to the cloud, how does that actually defend them against, say, Amazon or Google, who just have limitless cloud resources?
because that control allows for optimization and proprietary chip designs that are often just better than what a company focused purely on software can offer. Their platform creates a clear moat against single-point competitors, and they back it up with a pretty robust patent portfolio.
And this leadership claim, Wall Street seems to be buying it, right? What's the street saying?
Analyst conviction is strikingly high, especially for a company with these kinds of losses. The consensus rating is a strong buy.
A strong buy.
Yep. Average price targets are sitting in the mid-20s, with some of the more bullish ones reaching as high as $40. That signals some serious confidence.
And here's where it gets really interesting for me.
Mm-hmm.
Let's look at the price action, the actual stock chart. It has been absolutely wild.
Indeed. I mean, the market has certainly priced in a lot of that optimism. The share price has risen dramatically over the past year. It spiked from lows around, what, $1.28?
$1.28, yeah.
Yeah, all the way up to recent highs above $58.15. Technically, that paints a very strong bullish picture. They're trading above both their 50-day and 200-day moving averages.
Which is the textbook definition of a strong uptrend.
It is. And it's just, this is healthy accumulation, not just some momentary speculative blip.
So what are the key technical levels investors need to be watching over the next few months? If those Q3 results cause a pullback, where is the floor?
Key support is pretty robust in the $18 to $23 range. That's where we've seen major accumulation. Near-term resistance, the ceiling they need to break, is between $26 and $29.
And if they break that?
If momentum picks up, you could see a pretty quick extension toward $35, maybe even $40.
You mentioned momentum indicators like RSI and MACD are positive. For those of us who aren't technical gurus, what does that really tell us?
It basically tells us two things. One, the uptrend is healthy, but crucially, two, they aren't suggesting the stock is extremely overbought right now.
So there's still room to run.
Exactly. The runway isn't exhausted yet. There's potential for more upside.
Okay, so we've got strong technicals and bullish analysts. Let's talk about sentiment, because this is where the picture gets really complex. Who is actually buying and who is selling?
On the institutional front, the news is positive. Institutional ownership has gone up in recent quarters, which suggests the big funds are taking long-term positions. They believe in that 2026 inflection point.
And retail.
Retail sentiment is also broadly positive across, the financial forums, which tends to just amplify those upward moves.
Which raises an important question. How does that high institutional confidence square with the insider activity? Because in these high-growth, cash-burning names, insider selling is often a huge red flag.
And this is the critical nuance. This is where you really need to exercise extreme caution. Despite all the optimism from analysts, there has been consistent, significant insider selling.
How consistent?
We saw multiple transactions disclosed throughout Q3 of 2025, so July, August, September, showing continuous liquidation from high-level executives and directors.
Can you give us some hard numbers on that?
Sure, yeah. Just looking at September alone, director sales included 100,000 shares sold for about $1.54 million, and another transaction of 25,000 shares for over $460,000.
No, management will always deflect this. They'll say these are pre-scheduled 10b5-1 trading plans. What does that actually mean for an investor watching these sales?
Right, so a 10b5-1 plan is a pre-arranged schedule to sell shares over time. And the defense is that the timing isn't based on any negative inside information.
Why?
But while they're often legally defensible, the sheer volume of this liquidation is notable. You have to factor that continuous internal selling pressure into your risk assessment, regardless of the plan.
And this mixed signal, institutions buying, insiders selling, it's all captured by the stock's beta, isn't it?
Absolutely. The stock has a high beta of 1.65.
Meaning it's 65% more volatile than the market.
Exactly. If the S&P 500 goes up 1%, Rigetti is theoretically expected to go up 1.65%. But if the S&P drops 1%, Rigetti could drop even more. It really tells the whole story of risk versus reward here.
So let's switch gears to the immediate future. We have this high-risk, high-reward setup. What are the imminent catalysts we should be marking on the calendar for the next, say, 3 months?
The immediate focus has to be the Q4 earnings release, which is expected by early February 2026. This report is critical.
Why so critical?
Because analysts are projecting significant sequential growth from Q3 to Q4. If the company delivers, it validates that whole future inflection point thesis and could trigger a massive breakout.
And if they miss?
If they miss, or if the cash burn is still out of control, that high beta will punish the stock mercilessly.
Are there any scheduled market events we should know about, things that will affect institutional flow?
2 specific dates are key. November 28th, 2025 is important for potential inclusion in major ETFs.
Which would force passive funds to buy.
Right, can stabilize the price. And then January 11th, 2026, we get the institutional 13F filings. That's when we'll see if the big funds really are accelerating their buying.
And operationally, this company lives and dies by its tech progress.
For sure. We should anticipate announcements around new partnerships or product launches before year-end. Maybe key enterprise clients or, most importantly, upgraded quantum chips with better performance. The market needs proof points.
Okay, and finally, what about the big picture rumors? The speculative buzz that could move the price outside of scheduled reports.
There are persistent, unconfirmed rumors of potential M&A interest. Given their specialized hardware and IP, they're often cited as a target for larger tech firms, especially the hyperscalers, who need to catch up in the quantum space.
And beyond acquisitions, what about tech breakthroughs?
Well, there's always anticipation of an announcement, a breakthrough in processor milestones, like exceeding a new threshold in qubit performance or error correction. That's the kind of headline that can cause a massive immediate surge.
And government contract.
There's industry chatter about that, too. Securing a high-profile contract, maybe from the Department of Defense, given how much the U.S. government is prioritizing quantum.
So we connect all this to the bigger picture, those government contracts and just general commercial adoption. Those are powerful long-term tailwinds.
They are robust, durable drivers. The macro environment is supportive. As they look to expand globally into Europe and Asia in 2026, the demand for what they offer is only going to accelerate.
Ultimately, the investment thesis here remains just a case study in high risk, high reward. You've got potential for huge short-term gains tied to news, but also that long-term exposure to quantum leadership.
The next few months really do hinge entirely on whether management can execute their roadmap, restore confidence after all that insider selling, and, most importantly, deliver that projected growth in the Q4 earnings report. That execution is what will finally determine who was right, the bullish institutions or the departing insiders, and that is what you need to be watching.